Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
I am your host, Scott Henderson, and my co-host is Dr. J. We have a guest coming on today that we are excited about. Jason, who do we have coming on?
Well, Scott, a few months ago, maybe it's been almost 6 months ago, I was with another group that I'm a member of, and I listened to this individual, and I was very impressed with the fact of the type of work that she does and how she goes about it. We talk about on our podcast often about accumulating, enjoying, and passing on wealth. One of the biggest things that can help you in accelerating and in accumulating wealth is finding ways in which you are unknowingly and unnecessarily losing money. And one of those that most people complain a lot about, yet they don't know a lot about, is taxation. Now, our guest today is Terri Johnson. She's a native of Tennessee, and she's a partner in Capstan Tax Strategies. So welcome to the show, Terri.
Jason and Scott, it's great to be here today. And thank you so much for the opportunity to kind of chat with you guys a little bit today.
When you spoke or presented before, when I first met you, you talked a lot about cost segregations. And in the real estate world, that can be a huge advantage when it comes to taxation and how a property can be profitable. So at least initially, Tara, I know you have many other quivers in your and things that you do. But let's talk a little bit about cost segregation. Will you give us a kind of a layman's definition of it, and then let's talk a little bit why people should be doing it.
Okay, great. Sure. So cost segregation, kind of in its simplest form, is a way to accelerate depreciation. So when you buy real estate or you build a project, you have to depreciate that when the IRS gives you certain criteria. So you would depreciate that asset over 39 years if it's commercial, or 27 and a half years if it's a nursing home or multifamily, which obviously we see a lot of these days. And what happens is you are accelerating the depreciation out of that long asset into faster asset class lives. So the IRS gives you these definitions. So for personal property, which is the way you basically fit out a building for the nature and the use of that building, you would depreciate over 5 or 7 years for personal property. And for land improvements, and think in terms of, if you're outside, you've got parking lots and landscaping and stormwater retention systems, all that is considered land improvements, which you would depreciate over 15 years. So think about it. You're going from this long life of 39 years that is just sort of basic to having the ability to accelerate the depreciation into faster lives. 5 or 7 years for personal property and 15 years for land improvements. So what does that do? It gives you the opportunity to you basically take that depreciation and pull it up in the earlier years. So you're creating more depreciation in the early years, although over a long period of time, the depreciation would be the same. You're moving it forward, and then you have the opportunity to increase losses in those earlier years that offset income, so it lowers your tax burden. And then the owner is in a position like, okay, so I'm not paying so much in taxes. What else can I do with that money? And they're in the position to be able to increase wealth. They can buy other properties or do other things with that money. So what you see a lot of is real estate owners, when they use this, they'll do it on every project that they purchase. And it's kind of the gift that keeps on giving, if you will.
So let me simply run through some math and correct me in the event I'm wrong. Mm-hmm. So let's say I have a project that's worth $2.5 million.
Okay.
Over the 27-year rule, right? That's residential. I'd be able to claim $100,000 in deduction each year for 27 years. Is that correct? In this scenario, when I break up, say the structure versus personal property, I guess like carpets and draperies, and different things in these different categories, then whatever that value is, I then would say, and let's say, instead of, let's say the total value of all that was 500,000, instead of taking 1/27th of that each year, I could take and divide that up in 5 or 7, right? And get it that each year for 5 or 7 years. So my deductions truly are a lot more for the first 7 years, which would offset any kind of income. You could possibly make that property on paper anyway, paper being what you're filing with IRS, be a loss versus a rather good cash producing property.
Right, because you're offsetting the income that's coming in, and there's also this concept of bonus depreciation. So when the new tax law, we've had bonus depreciation since 9/11, basically. It was a way the government could give you incentive to get the economy going again. So the concept of bonus depreciation came about, and then under the Tax Cuts and Jobs Act, it was increased to 100% for anything that you move out of that long category into these faster 5, 7, or 15 years. So in your example, if you have $500,000 in deductions that you, by using a cost seg, instead of, if you were in a year that was 100% bonus, you take all of that in the first year. And what happened is, starting last year in 23, the bonus depreciation started stepping down 20%. So in 2024, we're at 60% bonus depreciation. So in your example, you'd have 60% of that number, the 500,000, that you would get in the first year, and the remaining 40% would flow over the 5 or 7 years and the 15-year categories. So it's even faster when you use the bonus depreciation.
It's simply not well known amongst most real estate investors. Why is that?
Well, I think it's dependent a lot of times on the CPA to talk with them about, that this is available, and to get a study done that can support. Obviously, you want to be in a good shape that you're having a quality study done in case the IRS were to audit you. But I think there's just a disconnect somewhere where there are certain CPAs that they really like using the cost segs, and they have resources to get that done, whether it's someone like my company or they have it in-house. And then there are this whole other group of CPAs that it's just not kind of ringing their bell. They're not paying much attention to that, so they're not telling their clients about it. And I think that's where you see that gap, Jason, that you mentioned.
Is it difficult to do a cost segregation? I mean, what's involved?
Well, it's not difficult. I mean, first you have to take a look at the project and really see, does this make sense? I mean, there's a lot of factors, and you want to take a look if it's new construction, or you just purchased something, doing it in the beginning. But you can also go back in time, as if you did it, like say you bought something 10 years ago, you can go back in time and do that. So it's not, you have to kind of first evaluate, does this even make sense? And then once you do that and it makes sense and the client's on board, an engineer goes out to the site, does a site inspection, and they're looking for certain things. They're basically quantifying all this personal property and land improvements in the base building, because you're actually costing out the base building as well. And they then go back to the office and they build these reports. And the only way I could describe it is, you take that building as if you were building it on paper by the numbers in each category. So electrical, plumbing, and all the components. So these reports can be hundreds of pages long, and it supports moving those assets into these faster lives. So there's multiple steps from the time they go out and visit the site, they build that report, write the report, and then at the end of the day, you want to make sure that it's defensible with the IRS should you ever be audited. And they have certain audit techniques, guidance, documents that have evolved over the years that the IRS has. So if you were ever audited, you want to make sure you're in compliance with revenue rulings and with their guidance, the IRS guidance, to make sure that you're doing it correctly. And I think one of the reasons some CPAs don't maybe recommended to their client is they don't have a relationship with somebody and they don't know if they can trust that it's being done correctly. Kind of to your point, if you don't have a quality study done and you get audited, you could be in a much worse situation than if you hadn't done it. So there's always that concern, I guess, with people that don't maybe have that relationship.
Is there a threshold, like a value threshold, or I mean, obviously, you probably wouldn't want to do a cost segregation in the event you were only planning on holding the property for a year or less, right? For the fact
Right,
that,
because
I mean,
of recapture.
Fix and flip. I mean, it's more something that your time frame is probably holding on the property for a minimum of 5 years or something like that, right?
Agree. Yes, you're spot on.
And what about the value of a property? Does it make sense? Because this report you're talking about, and I've seen them. I mean, Scott and I and have done these, and they're thick. They come in a binder. I mean, they can be fairly extensive and detailed. What would you say is the threshold? And what I mean by that, let's say I have in the Midwest somewhere, or someplace where real estate really isn't, hasn't gone through the roof like it has here in Utah or Florida or places like that. And I have a fourplex that say it's worth $300,000. Does that make sense to do cost categorization there? Is there a value threshold, or what would you say to that?
Yeah, I mean, I've always said probably around $1 million is a good value threshold. And then you throw in that bonus depreciation that I was talking about, and all of a sudden the threshold kind of goes a little bit lower. And it's an interesting point because what we've seen is that traditionally you would do cost segregation studies always on projects that were over $1 million and $5 million, $10 million, $100 million. I mean, some fairly sizable projects. But all of a sudden, when bonus depreciation came out and you could take a big chunk of that up front, and you had somebody that was investing in Airbnbs, for example, and they had a portfolio of them. So all of a sudden, like, I've got 10 Airbnbs and they're kind of in the same geographic area. You've got economies of scale. So they might each be worth $300,000, $500,000, but when you've got 10 of them, it makes sense. And so that's one of the things that I like to do up front is really evaluate, like, what is the opportunity? I run an estimate of benefit, which is conservative, but it would give you a feel of what you could expect. And then you kind of look at, if I'm going to pay X and I get this out of it, is it worth it to me? And you make that business decision based on that. But I mean, my theory always is, why wouldn't you want to look at that? I mean, maybe this $300,000 project that you purchased in 2022 when 100% bonus was around, and you can go look back and pick that up, and maybe it's fit out to the nines, right? And you've spent a lot of money on that property and making it just perfect. So the fit out is nice, and all of a sudden you might be accelerating 30% of that asset of the $300,000. And if you're at like let's say a 35% tax rate, then it's not a bad deal. So that's what I like to take a look at up front and make sure that whoever I'm talking to, that they have a really good sense of, does this make sense for me? Is this going to move the needle? And if I'm going to spend X amount on that project, are the benefits worthwhile? So I would say normally, when I do an estimate of benefits, super conservative. So typically the results are going to be much better. So it's kind of like a nice gift at the end. So it's, okay, wow, this was more than I was expecting. That's kind of the way I like to look at it versus being too aggressive on the front end.
I was real surprised to hear you say that you could take a portfolio of properties and do a cost segregation. I thought it had to be on one single property. But in fact,
Well, I mean,
we did three. I remember how long ago.
Beginning of the year.
It
was the beginning of the year.
Right. It was three condominiums within the same building. And we did three different ones. Are you saying that could have been lumped into one together?
Well, are they all in the same entity? Or are they different entities?
Well, they were different entities. However, if they would have been the same entity, we could have done that. I'm
Right.
simply
Well,
asking.
if
Some
something,
people
yeah,
don't.
so something like that, if it's all in the same building, which happens quite often, I would look at that as I would do one report and I'd have three subgroups in the report. So it's basically like you're breaking down those three. You're going to report those numbers separately, but you have one report, so your fee is going to be a little bit lower because you're basically doing one on-site and you've got one report with three subgroups. That's the way I would set that up. And then, but if you have 10 and they're
But if
all
it was
over
a
the
single
place.
entity, like you said, 10 different properties
Mhm.
inside that entity, you could do a cost segregation on all of those together.
Right, but in that case, if they were, say, in different areas and you have to go to each property, you might very well have to have 10 different reports because of the way they're totally different. There's like, you do 3 condos in the same building, they're almost identical. So the work it takes is much different than if you've got 10 totally different properties spread out all over the place. Then I would do 10 reports. But if you like, I just finished up we're working on a project right now that's probably 30 assets in New Jersey, and they're a similar property type. So I look at that as a whole portfolio, although each report is separate. I gain some economies by being able to have the engineer go out and visit several of those a day versus one a day. So that's where we'll do sort of portfolio pricing and look at it that way, but they won't be all in the same report. So it just depends kind of on the circumstances. That's why I like to look at everything in the beginning before the client's committed to anything and just really look at what makes sense here and what is the value.
Well, I appreciate that. One of the things that he had stated at one point is that you're very passionate about helping people fully leverage opportunities that exist that many people miss out on, particularly in real estate. Other than the cost segregation studies, what is something else that many people that's out there that people don't know? This bonus depreciation. I'm not sure that my accountants talk to me about that. So that's a good thing for me. What are some other things that you know that maybe some people need to be finding out about?
Okay, well, if you're sticking in the real estate space, I think that on the energy incentive side, we've seen a lot of growth in that area over the last 10 years. And there's a big impetus to build greener, sustainable projects where you're lowering the carbon footprint and that kind of thing. So what the government does when they want to change behaviors is they give incentives, right? So the one in particular is a program called 179 capital D, 179D, and it's an energy efficient study. So you can get, and at this point right now, it was changed under the Inflation Reduction Act, you can get up to $5 a square foot on commercial buildings for energy efficiency. But there's some
For example,
criteria.
what kind of energy efficiency? So be a little bit specific with me. I mean, is
Yeah,
that
so the
putting more insulation in
driver,
the walls? Is that changing the
yeah,
windows?
well, the
I
big,
mean,
yeah.
I changed all the lights in this building, for example, to LEDs from fluorescent tubes.
Yep.
Was it
So
expensive?
the electrical, the lighting, huge driver. The HVAC systems, the more energy efficient they are, big driver. And you mentioned insulation and the windows and even the roof and the insulation there. So what you do when you do a 179D study is the DOE gives you a software that you have to use, or several software that you can use, and you build a model that you input all this data of all the equipment that's being used as compared to a threshold, which is called the ASHRAE standard 2007. You don't have to remember that, but you compare to a standard. Well, that's an old standard, 2007. So you're basically comparing against, you have to be 50% or greater of this older standard. And then if you're doing like a renovation project, it's 25%. So you have this ability. Let's say you have a 100,000 square foot building and adjusted with inflation, it's $5 a square foot plus it adjusts every year for inflation. That's a nice deduction. So that's an additional deduction like you would get for the cost seg. So it's not a tax credit, it's a deduction. So that's one big thing that we're seeing a lot of. There's some issues with it a little bit in that the government came out and said, you've got to use prevailing wages to get this higher rate. If you don't pay prevailing wages, you get $1 a square foot. But they grandfathered the program in. So anything you built before 22 and placed in service 23 or beyond, you get the higher amount without paying prevailing wages. So we've just been really busy with that particular program. And then you have certain folks that use prevailing wages, so they can use this all day long, or they do low income housing, things like that. And then another program are tax credits for multifamily, where you can get up to $2,500 or $5,000 per unit based on being certified either Energy Star or Zero Ready Homes certification. So if you get either one of those programs, the Energy Star is $2,500 per unit. So say you have 100 units times $2,500, that's a tax credit. That's not even a deduction. That's a dollar for dollar tax credit that's available to you. So these are some of the programs that we're seeing, we're very active in helping our clients, achieve those benefits.
That's cool. You started in answering this as well. If we're sticking to real estate, this is what we're going to say. Are there other areas that you're seeing that many people are not aware of, that they can take advantage of better ways to reduce their tax burden?
Absolutely. So let's say you're a manufacturer, or you build software, or you make, involved in software, writing apps and things like that. There's the research and development tax credit. And I think that there's a huge opportunity for companies that are innovative to be taking advantage of that. I'm always surprised when you've got somebody that's spending a lot of money and time on improving process, or designing a new concept, or, and so you have to kind of eliminate uncertainty. You're working on a business case, a business component that is either new or improving, and it somehow has some kind of technology involved in it, whether it's the sciences or engineering, that kind of thing. And then there's a process for experimentation. So those are really the four things that you look at with an R&D study. So what happens is that you get this tax credit. Again, we look at this project up front, and you're really looking a lot at wage data. Who's involved in that project as far as your employees are concerned, and what percentage of their time, and what are their wages, what consultants are involved, and they all have to be in the United States. They can't be overseas, because there's an incentive to keep the jobs in America. So once you get all that information, we can put together some kind of a estimate of benefit of what kind of credit they could get. And then it's a matter of, once we get that project, is interviewing those employees and really looking at all the different projects that apply, and putting a report together that justifies and backs up taking the federal tax credit, plus a lot of the states have a similar R&D tax credit. So that I think is very underused. I think there are certain companies that have been doing it forever. It's been around a long time, and others that maybe be doing that. You might have like an owner of a company that's constantly thinking of new things, and let's try this and let's do that. And maybe almost 90% of his salary is innovation. And then you've got like a department that is working on these projects maybe 50% of the time, but they don't stop to think, wow, I could get a tax credit for this effort. So our goal is to kind of come in and take a look at what they're spending, what projects they're working on, and does it meet this 4-part test? And if it does it
seems
make
like
sense
to me every single business has the potential to qualify for that.
Well,
every
it's
business
funny,
is evolving. Every business owner, like you said, is thinking, okay, do I change my ad? Do I change my, the storefront? Do I change the furniture in my
yeah, but
waiting
it has
room?
to be there has to be a technology component. So let's say I'm looking at, I make lipsticks and I'm looking at changing colors. That doesn't apply. That has to be a technology type thing. So I'll give you an example in the real estate world is if you're an architect and you're designing a project and you're paid in a lump sum. So that makes a difference. If you're paid time and materials, you're really not at risk. But if you're paid lump sum, you have a lot of risk, because if you're going through multiple versions of this thing, version 1, 2, 3, and you go over and over and refining, what are you doing with that? It's a process of experimentation, right? And it's in there engineers involved in the project and that kind of thing. And you can actually get as an architect, get a research and development tax credit when you're being paid on a lump sum basis on these type of projects. And when go ahead. No, I find it fascinating. So you think the typical would be a pharmaceutical company or a manufacturing company, but when you start thinking about, I mean, we've had clients that they build online games and they're getting these fairly sizable research and development tax credits, and they're having the best time of their lives doing their job, right? So it's kind of fun to be involved on that side of the business as well.
As long as you can prove that there's technology involved, at least an improvement in the process, that's key. Okay. I want to turn it a little bit to kind of a personal way, and I'm not mean personal to me yet. What are some things that you find that an individual, let's say in the higher income tax bracket, the fact that maybe they're sole proprietor or something, what are some key things you can see that they are tax advantages that people are not taking advantage of?
Well, I mean, I think a lot of the things that we're talking about is, how they've got everything set up, and can they take advantage of these? I mean, are they using trust vehicles and things like that? Or are they're very high income and ways to basically lower that income to lower their tax burden? So, bless you. So everything that we've been talking about is lowering their tax burden, and it's giving them, I kind of stick to my knitting in this whole world of depreciation deductions and tax credits. But I have seen it be a very powerful tool for high net worth individuals that own real estate. And literally they will come and say, they'll get a call and say, we've done like 20 projects can you send me a list of the projects? Because I want to make sure I haven't missed anything, because it's just so powerful. And if you're building and developing, buying real estate on an annual basis, it can have a significant impact, because it's like the gift that keeps on giving. You go back, do it again, and then it'll especially where bonus depreciation is around, you're going to get that big hit in the first year, but then it frees up income to buy other projects. So I don't know if that answers your question, but I mean, that's kind of my world. And I see it all the time, and we deal with a lot of high net worth individuals, and some of them are doctors, and they might, they're buying triple net lease deals where like Walgreens and CVS, and where they don't have to actually manage that project. They've got a tenant in place, and I call it clipping coupons. But if they can lower their tax burden on those deals, but you keep in mind, because they're passive investors, they have to have passive losses that offset passive income. So that's another area that you just got to work with the CPA and then make sure that this is going to work for them. Because if you are a passive investor and you're getting all these losses and you can't use them, then that's a problem. So that's one of the reasons that I really like working closely with the financial folks, whether it be the CPA or the financial advisor, to make sure they can actually take advantage of this. So, what you do for your day job can also impact the results.
Scott, do you have any questions?
Not off the top of my head. Is there, what's the next goals for you personally? What is that next mountain peak you're trying to climb?
Well, I got to tell you, I am very passionate about what I do. I love the business, and I really enjoy being a partner in a company where we have new blood coming in all the time. And we kind of pride ourselves on being a destination company where everyone can kind of work and do their thing and create a culture where people want to be. And we just had last week our annual meeting, and you look around and you see the growth and how everyone's having such a good time, and you to be very purposeful about how you bring all that together and how everyone gets to know each other and rely on each other and create that kind of teamwork. And it's, to me, that's the most fun of what I do. You know, I love helping out my clients, but I love looking around and just seeing what you're creating and hopefully building a legacy where this company will continue into the future when I'm long gone. So I know that's what I get up in the morning, and that's what puts a smile on my face first thing. So awesome. It's a lot of fun.
Awesome. And switching your perspective too, going to the past, if you were talking to yourself when you're first coming out of college or getting into the workforce, what would be your piece of advice?
You don't ever underestimate yourself. You know, if you're young and you're smart and you have good intuition, go for it. You know, and don't hold yourself back because that's what people tell you, that, oh, you can't do this, you can't do that. And so, I mean, I've been around a long time. So when I was young, you know, it was, I guess you kind of played your role and you didn't necessarily get out there and be super confident. And as I have grown and the world has changed, I have found that much easier to just be myself and to enjoy what I do and hopefully help people along the way. You know, I mean, that's really what it's all about, is relationships. So I would tell myself, just enjoy yourself, have fun, go for it.
Awesome. Awesome. Well, we've had a blast having you on. Thank you so much.
Well, it's been great to be here.
Some great information, Terri. Yeah. Everyone will put her contact information in the show notes that they can reach out to Capstan Tax Strategies, and specifically to you, Terri, as far as someone wanting to look at these cost segregation studies and learn more about it. I mean, you've been doing it for quite a while, right?
Right. A long time. So I've been doing this with this company for 20 years. So it's a long time.
Yeah, you know what's going on. So it would be in very good hands. Sorry, Scott, I cut you off. Go ahead.
No, that's fine. If any of our listeners wanted to connect with you, how would they go about doing it?
So you can email me at tjohnson@capstantax.com, or you can give me a call in my office, 215-885-7510.
Perfect. And guys, we will put that all in the show notes down below. Terri, thank you again. If you'd like to connect with Jason or I, make sure to hit us up on Facebook, Instagram, or your favorite social media platform. And if you like the show, please leave us a 5-star review. It really helps out. Last, remember, mastering your millions all starts with your mind and your team. Make sure they are the best. We will catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.